Welcome everybody to our first video commentary here. This is something we're doing in response to some of the feedback we've gotten of late from clients saying, hey look, I don't always have time to read a 7-page white paper. Love to be able to consume some of this content in video and audio form, as well as just have the tone to really understand what I'm trying to say within that, and that tone can often obviously be hard to convey in writing. You'll have to bear with me. Unlike my 2-year-old daughter, Adeline, I'm a rookie in front of the camera, so you'll have to learn and grow with this as we go. But our goal obviously is to continue to provide good content for you and hopefully things that you find of value to help you have more clarity and confidence moving forward in the market. So today, to that note, we're going to talk about 4 things that are constantly trying to attack us as investors and keep us from reaching our financial goals, and rarely come up too directly, certainly together. And instead, obviously, people are focused on some really myopic type topics. So let's look at what are these 4 things. What are these 4 horsemen of the investor's apocalypse, if you will? Number 1, the markets themselves. And when I bring this up, as we'll talk about here in just a sec, I'm not talking about market losses. I'm really talking about it within the context of investor expectations and how that can be damaging. A second one is the media, and to that end, they may not necessarily have your best interest at heart. For the first, hey, needing to keep your attention at all costs, and for the second, obviously needing to appease their shareholders at all costs. Number 3 is life itself. We have so many things playing on our time, our emotions, our finances, and all those things can be real distractions and or just impact us negatively in our decision making. We'll touch a little bit more on some real world examples that we often see. And finally, you, us, me, any of us naturally as investors, and how we're wired to think and make decisions, particularly in times of stress, and those can keep us from our goals as well. So we'll start out here with the markets and really how we think about some things. The key, as you may have heard, you've probably read in one of the commentaries, the old adage, it isn't timing the markets that's critical, it's time in the markets. And how do you buy yourself that time? It takes a lot of patience and discipline. What's the enemy of patience and discipline in a lot of cases? Having what we expect to happen, not happen. To that end, I think most people know markets have averaged around 10%. Again, we're talking about stocks. We certainly invest and tell clients to be diversified into a lot of different types of things. But to keep the stats simple, we're looking at stocks historically around a 10% type average. But if you look at how often average happens, you've got a 5 to 10% range we took a look at. And in the last 90 years, that 5 to 10% type range that I think all of us are kind of looking for as we open up that statement has only happened 9 times. Put another way, 90% of the time, what an absolutely understandable and knowledgeable person would expect to happen doesn't. So what is happening? Amazingly enough, extreme markets. In the last 90 years, if we include a couple 19.8 type percent years, 40 times in the last 90 years, you've had a market that's been up or down more than 20%. So we're talking about here not having expectations met. Here we're talking about having those 2 twin enemies of successful investing, fear and greed, getting played on with 4 times the regularity of what we would expect and perhaps even need to just help us naturally with our patience and discipline. Key thing. Going back to, though, what can I expect long term? And contrary to what you see a lot of times in the press, 73% of these years, 66 out of the last 90, you've had the markets finish the year with a positive return. I think this is fascinating. 1, I don't think it's what most people would, again, expect. But number 2, if you were to come down in that proverbial spaceship and read headlines and see video clips of the types of things that are out there, I think you would think the market barely ever went up, let alone almost 3/4 of the time that you're going to get that positive type return in the markets. So what's the 100%? Well, the 100% is my rough approximation around how many times the media is trying to mislead you in terms of what's going on. So going back to our second, 4th horseman, let's look at the media and the press. So this week obviously was a week of a lot of news. You had the tariffs have dominated the headlines. Economic advisor to Trump, Gary Cohn, resigns. And out came all the hyperbole. Again, rarely do you hear patience, discipline, hyperbole, and yet that's obviously what the press tries to put out there. So let's take a quick look. Tuesday night, I'm out on a date with my wife and checking out some Twitter stuff when I have a moment, and what do you see? Cone out, short equity, short the US dollar, buy gold. This is Doug Cass, frequently on TV of the street. Good old Kramer, this is a day or two before, if Gary Cohn resigns, watch out for the stock market. Simultaneously with this, the after hours market, very thinly traded, down 2%. Looks like we're gonna wake up to a really bloody Wednesday. And what actually ends up happening? Wednesday starts out, S&P 500 gets back to even, the NASDAQ finishes up, the European markets finish up, and here we sit here at the end of Friday, and markets have rallied up to about 2% gain from close on Tuesday. Other things, obviously, that have dominated, and we look at these four horsemen in the media, think North Korea. 6-9 months ago, all you could hear was, hey, you got to get out of stocks. There's going to be a war, geopolitical scares, the dreaded black swans. Kim Jong-un's calling Trump a dotard. Trump's calling him a rocket man. It's devolving. It's juvenile. Fast forward 9 months. They're sitting down in May, we learned this week, and we're going to talk about the denuclearization of Korea, possibly even long-term a reunification with the South. Markets rally off the news. What's the point of all this? Number one, nobody knows how to predict the future. I think everybody says they'll agree to that, and yet they'll tune in and oftentimes let these narratives dominate you into trying to think you can predict. The second thing is there's so many variables that are impacting markets at any given point in time. Not only is it difficult to predict whatever one variable everybody might be focused on, there's so many other things that are playing in. Right now, yeah, tariffs aren't positive. The last time we saw this was 2002. Markets during that time from 02 to 03 were down about 4.6%, not 46% like the media might lead you to believe in some of the headlines. You've got tax reform, you've got deregulation, you have earnings growing at north of 20%. A lot of positive things in the markets. And again, don't get swept up in those narratives. Third and finally is just life. So, we talked about expectations and tuning in. I think a very understandable thing that people are thinking all the time is, what is it working, right? Am I on track? Am I on pace? Am I okay? But we're busy. So we look in from time to time. We're busy. We got kids' soccer games and work and families and all sorts of stuff. We pop in and look in, and again, we're seeing one of those 40 out of 90 type years, obviously 4 times more than what we think we should be seeing is happening. On top of that, you have emotional stresses that are clouding decision-making ability. You have financial stresses that are clouding decision-making ability. And this is something, again, a good advisor should be helping you through all the time, how that interplays with your decisions, checking those emotions, helping you be prepared in advance for the financial stresses from a strategy perspective. Finally, somewhat related to these stresses is the same part of your brain that's triggered by losing money is triggered by mortal danger. So when you think about that, yes, when it's calm, when the markets are good, it's easy to say, yeah, I know the craziness is a part of the average market cycle, and yet we know biologically our predisposition is to freak out, to be emotional, to make emotional decisions. How can we avoid that? Again, having a process laid out that we can rely to, and instead of trusting our gut, having a great partner. For us, not only internally a lot of great partners, externally. We hope that you have someone you trust and you can work with that can be your partner there. All these different things are forces and factors. All of them, the most important thing and what I wanted to get through this video is just knowledge, understanding what really should be expected, understanding and expecting how you'll behave in certain situations, and then thinking in advance of those situations to put some steps and processes in place to help you be a great investor. So when people come to us and they say, what's your take on Apple or Bitcoin or whatever, and we look at them with kind of a blank stare, a reason is it's just not where we're putting our focus. We're putting our focus on individuals and helping them get away from the 4 dangers that are attacking their plan and letting either the markets themselves take care of things or professionals we're working with focusing on those little myopic pieces of the picture. Because if you go through And again, you think through that first thing of market expectations, up, down, up, down, up, down. This isn't how we need our budgets to work. This isn't how we hope our retirement plan operates. And how we can help people navigate through that, that's where we're gonna put all our time and attention. It's certainly where we would encourage investors to put all their time and attention. We hope you found this valuable. A lot to unpack out of this. Things will unpack in future weeks. We look forward to seeing many of you next Friday at our big event. And thanks so much for joining us.